are in listen-only mode.
Okay, I'm just going to wait just one more minute and get things started here. Seems like we have people still attending the webinar. I'd like to thank you all first for taking the time out this afternoon. All right. I'm going to try to keep this webinar pretty short, hopefully under 45 minutes. I know that sounds kind of long to some people, but if you've been to previous webinars of mine, they usually tend to run long. So I'm going to try to cover, the main premises of of what I want to cover within the first 20 to 30 minutes, and then I'll just open up to Q&A afterwards. This webinar is going to be recorded. It's going to be posted to the briefing.com YouTube page. You should be emailed it out. There should be records, there should be links embedded somewhere in the site over the next few days. So you should be able to see it in case you have to leave early or you can't stick around for the whole thing. Does anybody want, just not too many people, just tell me if you can hear me okay. Just like to see, there's a box that says in the chat, you can just sit there and say, okay, good. So I got people that can hear me. Thank you very much. All right, let's get started here. If you have any questions, you can just type them in that chat box, and then I'll look to answer them towards the end. I'm just going to try to cover as much as I can, and I'll go back to different charts if you have examples. All right, so what I'm going to cover today is my favorite earnings patterns for day and swing trading. I've been in this business for just about 15 years now. Seen it all, with extreme highs in the late 90s, extreme lows at least 2 or 3 times over the last decade, and tons of earnings seasons. And for me, earnings seasons is always a wild card. It can really make or break a chart pattern that's out there. I always joke around saying that the fundamentals are only good 4 times a year, and all the other days in between, it's all about the charts. It's all about the technical levels that you have to pay attention to. So for this, I never really predict earnings. For me, like I said, it's always a wild card. I'm not going to sit there and jump in expecting somebody to a stock price to gap higher or gap lower the next day. I'm more of a reactionary earnings person. It's the patterns that develop after earnings that I'm going to be more prone to trade as opposed to the ones that happen just ahead of time. So with that said, let's just go right into the slides that I have here. Let's see. The 2 biggest things with earnings are the reactions, and those reactions are going to be 2 key things, in the market. It's going to be either done in big gaps or small gaps. The larger the gaps, or the more significant moves away from recent trading ranges, either breakouts above key support areas or breakdowns below, breakouts above key resistance areas, and breakdowns below key support areas. You're going to see a total shift in mentality, a shift in attitudes, emotions, the money, people who have money riding on these positions. Wide gaps, the wider the gap and the more significant the breakout or breakdown, it's going to create a certain shift going forward. The way I like to measure gaps is usually by the ATR, or the average true range. If you don't have access to that, you could just eyeball it. You just kind of look at the recent price activity of a stock, and you can just kind of sit there and say, all right, is this gap significantly larger from where it's been trading up to the point of earnings? If it's significant, there's definitely going to be some sort of shift in supply and demand. The smaller reactions, usually when a stock trades, within close to the ATR, say the average true range is about $1.50. If the stock only opens up $1, $2, you're probably not going to see too many people panicking out or making some sort of rash decisions to their portfolios. More than likely, you're going to see those are the kind of positions that people are going to add if they're in a losing position, or short more, or they're going to try. The day traders are going to try to fade those types of moves. It's the larger gaps that really tend to become more of a momentum trending type of move over the course of the next few days. Also, with the smaller reactions to earnings, I wrote here that it gives people more time to assess the situation, and there's going to be more delayed reactions, and people are going to wait to see what happens over the course of the next few days or few hours. And also on those small reactions, this is where conference calls usually can be a key catalyst. So, for example, if a conference call happens, say, 2 hours after the market's opened, and the stock really hasn't done much, usually what management says on the conference call can be a generator of momentum or a spark in something activity. So it's just something to be aware of when you're going forward. To the surprise of much of my colleagues, I actually do focus on fundamentals just a little bit. And the few things that I want to focus on are the earnings surprises, which just basically means if the company beat, meet, or missed analyst estimates, and how significant was that surprise. I also look at year-over-year revenues. You want to see if a company is profitable and by how much on a year-by-year comparison. Usually you're going to see a much higher percentage change there among leading growth names. And here's a little plug for the Briefing in Play Plus focus lists. We have the liquid momentum names, which is what we consider to be the best relative strength and leading fundamental stocks in the market on a large cap basis. And then they have the emerging growth focus lists, which are highest relative strength, leading fundamental growth names on a smaller to mid-cap basis. And if you ever look at our website, you're going to see that those year-over-year revenues, the percentages are just usually in the 40 to 50 to 70% range, as opposed to something like a GE or a Walmart or a Microsoft, which usually only beats by about 3 to 8%. You do look at guidance. You always want to see what management, what their plans are for the coming months. This is not a requirement from companies to post. So some companies don't do it. Financial companies rarely do it. It's more usually among retail stocks. And they don't always do it for both earnings per share and sales. And sometimes they give a quarterly outlook or an annual outlook. It's just something to keep in mind, when earnings just come around. And then conference calls. Again, what management says on the phone could be a significant thing. So these are just some of the few fundamental factors that I just want to be aware of. I don't put too much emphasis on it. Again, I'm pretty much a strict technical analyst, but I'm always looking back on the fundamentals just to make sure that the technicals line up with the fundamentals. If you're not familiar with it, briefing, the earnings calendar that we do have, if you go into the calendars heading, you can click on earnings results, and you're going to see a page similar to this right here, and you can see exactly what I'm talking about. And pretty much what I just said, that what I focus on comes right from this page. I'm always looking at the surprise or the beat or the miss, and I'm looking at the year-to-year revenue over here, and I also want to see what the guidance was. And you're going to see little arrows going up or down or sideways to tell you if the revenues were guided higher, lower, or in line. And you can just go right to earnings guidance, or you can type the stock symbol that you're looking for at any time in the ticker search window at the top, and then click on the guidance or earnings related links if you don't want to stay away from the earnings page itself. All right, so I'm going to get into examples of how I view the market. Again, and how I try to trade this during earnings season. We're going to start with small gap examples, and I usually try not to trade these too much. I find these to be more of the better day trading scalping scenarios. Perfect example here would be JP Morgan. So this had earnings about 2 days ago, 3 days ago, and you could see that it actually opened inside the prior day's range. To me, this is not a significant mover. Anybody that was long leading up into earnings probably was not really panicking out of selling stock into the small opening here, which was less than, I think it was about 25 cents from the close. The average true range in the stock prior to this was about 90 cents. So this is really nothing significant on the chart. Even if you were short the stock leading up into it, you're probably not even, depending on your size, you're probably not even looking to take profits at all. To me, this is really kind of a muted reaction, a non-event. On such small reactions, like I said earlier, you're going to be more prone to a fade or some sort of chop thereafter. And this is I focused in on a 5-minute chart. So the opening broke the prior day's range low right here, and within the first 5 minutes, it just completely reversed. So if you go to day trade, I would definitely say, you want to look at the initial opening push on these smaller reactions, and then once you start seeing them reverse, you can probably just jump aboard, and it could be good for a quick scalp that morning. A few other examples was Goldman Sachs. Goldman Sachs, we have a $148 stock. That puts the average true range of the stock well over $3 on any given day leading up to earnings today, and the stock only opened up probably about $1.25 from the closing price. It should have, if a significant reaction would have been well over $3, gapping it above the prior day's high, or even gapping it down below the prior day's low. For me, this was just a small reaction to the earnings results. Therefore, it becomes more susceptible to a fade or some sort of chop, and you can see that it opened higher, and immediately sellers just started knocking it right back and took it right down below the opening. If you're a savvy enough day trader, I'm sure there was a short entry to be had there. Johnson & Johnson, another one that reported earnings today. This average true range is a little smaller. It was only been about 75 cents, but it's been a really, really strong stock over the course of the last 3 or 4 months. It's actually been one of the leaders in the staples, I believe. And, it had earnings, and it opened inside yesterday's range. And to me, again, this is one of these things where it's really difficult to actually to judge of whether it's going to people are going to start fading it, or whether the people are going to start adding to their positions. In this case, the stock opened higher. They tried to knock it down a little bit, and then they started taking out the opening range highs. And you can see that they were already adding to this winning position and just taking it up higher into higher ground. Going back a few weeks ago, we had Cisco report earnings, and Cisco has an average true range of approximately 30 cents. So it's about a $21 stock prior to earnings, and it has an average true range of 30 cents. It opened down about 30 cents in reaction to earnings. Again, to me, that's just not a trade that's going to be this big earnings mover that day that's going to make some significant move. It's probably just some sort of small minor opening reaction that you can probably look to try to trade some sort of reversal off the opening. And you can see it just becomes, that small little reaction just becomes very vulnerable to fading a position. And this is the case here back on February 14th. And then you can see how it kind of goes into this little chopping pattern, the next day or two. So that's pretty much the reactions to earnings. I really try not to play with them. I try to avoid the whole, immediately taking a day trade off the opening. But if that's your game, then this is just something to consider. The gap, the reaction to earnings, the size of the gap is can really set up the framework that's going to be throughout the day. If it's a really small opening, you probably want to start looking to fade some sort of opening reversal, or you want to start going with the trend on some sort of opening range breakout. Now the larger gaps and reactions. This, like I said earlier, this is a significant shift in investors' attitudes, emotions, and most importantly, the positions. The one key thing that I like to watch for on these large gapping moves is I want to see who's trapped. That's the number one question I always ask myself. When a stock gaps a certain direction and it breaks out above significant resistance or breaks down below significant support, I want to see who's on the wrong side of this trade before I decide to trade the stock at all. I want to see who, because this is a game about risk management, and if you have a significant size gap, institutions, portfolio managers, they basically it becomes a game of risk management at that time. They're probably not going to be looking to add to a position that's already a significant loss for them, and they're basically going to be, looking to either cover or sell the stock, to minimize their losses. So, example, when you see a trap position, trap longs will usually sell into rallies all day long, and trap shorts will cover on the dips. And I'm going to show tons of examples for these in a few minutes. I see two quick questions come in. Yes, this is going to be recorded, be on the YouTube channel, and it will also be sent out to people that's registered for the email. Also, going forward, the large gaps, if you're not day trading, you want to make sure that you are well aware of the actual range of that earnings day. The range that, if you can just mark off the range, and I'm going to show this in a chart in a second, it becomes it's almost like earnings. When you see a large gap, it's like hitting the reset button on the chart. 4 times a year you can actually, it's like the chart just start from the beginning, and you just have to create, and that range that happens on that earnings day, it's almost incredible how it just starts to act as a new support and new resistance going forward in coming weeks. And this is where the swing trading application starts to really kick in. A few terms I'm just going to use real quick. It's pretty self-explanatory, but an earnings gap is when a price gap significantly through prior support and resistance zones. A gap support and resistance is the high-low of a range, the day of the earnings gap, which I just explained. The first retest and a reversal of this range is usually confirmation of support and resistance, and 9 times, well, I wouldn't say 9 times out of 10, but it's sets up for a really, really good swing trading opportunity. And the beauty of this is that it usually happens, say, 2 to 5 days after the initial gap, and by that time, nobody's talking about the stock. And I think that's like one of the key points I want to make here is that you know, it's so easy to get caught up in all the headlines, and especially during earnings season, everyone's all focused on, you know, the initial stock, the initial moves, initial pops and drops. But if you ever watch a stock about 2 to 5 days after earnings, and when the dust settles, that can usually be the most profitable, low-risk opportunity to jump in long and short on the name. And I'm going to show you a few examples going forward. The other type of gap that I like here is I just kind of reference this as a gap and go. And basically, after a significant gap that breaks through a significant support and resistance area, price continues to move in the same direction for a couple of days, minimum 2 days. I just want to see price go, you know, close above the earnings day or close below the earnings day gap. Sometimes it lasts longer than just 2 days. It can last 4 or 5 days. So that's that type of pattern that I see there. And when you do get that multiple day run in reaction to earnings, the first pullback becomes extremely important to watch, because that's usually the one that's going to be your new support and resistance zone. It's not going to be the initial gap itself. It's going to be the first pullback after a multiple day push and run. All right. All right, so this is the summary right here. So I'm just going to move into the charts. All right, I got a ton of examples to go through here. Let's see. First one we have here, I'm going to start going through some earnings gaps that I posted. So Fleet Core, this is on our liquid momentum focus list for a good couple months now. You can see it's been a leading growth name fundamentally, and technically the relative strength has just been pacing the market higher, you know, the latter half of last year, and particularly more so this year. It did have earnings in early February. I'm just going to try to do this tick by tick, or day by day, so we can just kind of get a better sense of how I analyze this in a real-time basis. So we have this huge gap open of about $4. The stock, and again, this, if you're day trading this, you got to ask yourself this: here's a strong run-up. All right, the stock was settling ahead of earnings around the $60 level. You know that there's short positions that basically we're going after some sort of double top action here and a couple down days here. So when the stock gaps up $4, you know that these short positions are about to get squeezed and they're going to have to cover. That basically explains why it gapped up almost at the 64 level. There was pretty much no move to the downside, and the stock just squeezed up throughout the entire day, up another 4 points. And this is why I don't trade the day ahead of earnings. I want to be the guy who buys stock at the opening, knowing that these short positions are going to have to cover. So that's the first thing. I just labeled all the earnings gap too, and the fundamental side of it, just as a reference point. So it's actually, you can see too that since this is a growth name, the year-over-year revenues were up 47%, and the earnings surprise was beat by 7 cents. Plus, you guided higher. I mean, this stock had everything going for it for a squeeze. This is the type of stock you want to, you know, really focus on the long side. That day, it opens up higher. The next day, inside day, I would deem this to be a, you know, usually some sort of first pullback or pause in the stock. Second day, by this time, nobody's day trading this probably the third day after earnings. You can even see the volume dropped off significantly. Very few people are paying attention to it. They moved on to whatever new headlines are, or whatever the next earnings release is. Here's another inside day, small doji day, even less volume, 340,000 shares. I mean, this is just not. This is coming off everyone's momentum radar really, really fast, and this is the time you really want to start focusing on these type of trades for swing trades. And you'll notice here that the lines that I drew, I put a line right at the gap low, and I put it at the first pullback high. And these are going to be basically my range that I'm going to be focused on. And you want to be a buyer down here around the 64 area, and you want to be a buyer if it breaks out, if it continues and breaks out higher. You can see it started moving up the second day after it paused. This is what I just called like the first pullback or pause in the stock. And if I keep moving forward, big breakout. Stock just rallies up back to the high here. You could jump aboard long that day, and just keeps going higher. Pullback. Now this is another key one here too. That first pullback day, when price pulls back in, it's going to act as a new support area that you're going to watch. And this comes back to what I said earlier. Always watch the first pullback day and how price reacts to it. You don't have to necessarily be focused on this gap support level down here. So you can see price actually dropped, and it held the exact breakout point. Price went sideways for a few more days, and this is your newest support zone. This is a game, when you're swing trading, it's about managing your risk and sticking with the position as long as you possibly can. If you take any sort of entry on this breakout, or even if you bought on this pullback here, your risk level, you should be able to clearly define your risk level. Something on those charts that I showed earlier, JP Morgan, Goldman, they were still within their prior range. They were still within their just weekly ranges. I mean, it becomes a little bit more difficult to establish your risk levels. If you focus on charts that are gapping up significantly, usually you can see a clear, significant support and resistance area developing that you're going to want to just manage your risk accordingly. Now you can just see that Fleet Core just took off after that. Really nice. You can just take partials on the way up and just trail a balanced stop through the rest of that. Gmcr, Green Mountain Coffee, is another stock that's been around for a while on our focus lists. And you can see back here in November, big earnings gap. Again, first thing I ask myself always is who's trapped? And you can see right here that anybody that's short is definitely trapped. Year-to-year revenues were over 30%. The earnings surprise was 16 cents. So again, it gapped higher, didn't even come in. Again, if you're day trading, these are the type of stocks you kind of just want to jump on board right away at the opening, and see how much you can actually squeeze people out of this for. You can see the next day there was a little pullback, and when the pullback starts, this is usually going to be the new established range going forward. And you want to either buy a breakout or continuation in the direction of the gap, or you want to sit there and just see how it develops, and then buy. Again, you're looking to buy the continuation of this gap. Price broke out big time from about $37 to about $42 for a $5 gain in 3 days. Pulled back pretty hard, and lo and behold, look where it stopped, right along the high of the first pullback day. And you could have took a second entry there if you missed all this, and it started bouncing higher there. So that's another example. Let's see if I had another one here. I do have multiple examples on some stocks, so let's see. This one is a good one on the short side. So STX, Seagate Technology. This again was on our growth lists and focus lists. And you can see on earnings, earnings weren't too bad, but the company guided lower, and the stock price gapped down. And it gapped down, looks like about $2 or so. And it's a significant gap. I mean, you went under almost 4 or 5 days of almost a week's range, especially this long, high volume, wide range bar here, which a lot of people bought in on. So you have trap positions up here, and there's going to be some selling pressure on a significant gap lower. Now, this is a good example to show you that not everything is perfect. Technical analysis is more of an art form, rather than exact science. But I just want to show an example here of how, here's your first pullback after the stock price gap down on the second day. And I'd be looking to go short underneath these lows right here, or potentially go short on a retest of the opening gap down resistance right there. What happened was the stock actually gapped lower. To me, that's an extended move. I'm not chasing any sort of moves after a significant gap. And you can see most people weren't either, and the stock hit a low of 33 and just recovered real quickly. Now this is key here. So after a few days, the gap resistance, this zone right here, particularly the opening of the earnings gap day. And this is why I said try to mark off the highs and lows of the actual earnings days themselves, because they're going to act as support and resistance areas. So 1, 2, 3, 4, 5, almost 6, 7 days later, I don't know how many more people were actually trading this, because they probably moved on to some other headline or some other stock reporting earnings. But price broke out above the gap, and this is a pretty hefty squeeze here. Next day it came flying back in and kind of just sat there and didn't do much, and then it kind of rolled over, and it wasn't really it was struggling to really get past and move its way into this gap, and that's a good shorting opportunity. You want to look for stuff like this on a swing trading basis. Go short the stock here, maybe risk $1, even risk this upper end of the gap, almost $2 if you could, and then you just kind of watch it roll over right back down to the lows. Take out the prior range lows there for a nice gain on a swing trading basis. Let's look at Oracle. All right, so Oracle actually, let's see, here's the earnings gap I want to focus on. Again, stock ran up and it gapped higher, so you want to know, who's trapped in this position. Well, this seems like a pretty significant breakout, almost at a 3-month high here, and the stock ran up. So anybody who's short is going to be forced to cover on this opening gap. If you're day trading, you probably want to just take the long at the opening and scalp it for a quick trade as it squeezes higher off the opening. The next day you kind of have this little pullback action here, and price came in really hard. It came below. I think the key thing here, again, I said mark off the earnings, the high-low range of the earnings day itself, like that. And you can see that by the second day it just kind of gapped lower and it became new resistance right there. This probably would have fallen off my radar. However, I had an alert set down for the 33 level as well, for a gap close, and you can see that that was the case a few days later. Stock probed that level, became a gap support area to focus on, and then January 1st came around and everything gapped up that day. Probably a little bit difficult to trade, but the key thing to recognize here is a lot of people try to get in really early at key support and resistance levels. If you're swing trading, there's really not much of a reason to get in early. You always want to wait for confirmation. So in this case, when price probes, and then into the afternoon when you saw prices rallying and closing positive and reacting strongly to a key support area, well then you could take your long into the close. If you're going to jump in early, if you're not a day trader, I recommend taking a half position and then adding it if there's confirmation. If there's no confirmation and the price just keeps going lower, you take your loss on half your position. I'm going to come back to this one later because it's a different type of pattern. Let's see, I got Starbucks here. Starbucks, another earnings gap back in November. Gapped up, and you want, again, this is pretty significant. It's a $3 or $4 gap up, which again is going to trap a lot of short positions. So if you're day trading, you could have just bought at the opening and squeezed it higher. Especially it's beat by a penny, got it in line. So you kind of just knew that there was a bullish bias going into it with you. So here again, the next day you have this little pullback action, and if you just marked off, let's try to close that. You mark off the range, you have a pullback right there, and now you can see that this actually failed to look like. So if you watch the pullback, you can buy above that pullback high, try to probe the range highs, which actually acted as resistance. Price came back in. I would have been very tempted to buy right here. This is a huge gap support. If you could see that price actually closed down on the day. Again, this is why I said you got to really pay attention to how prices react to such key levels. In this case, it closed lower. I would have liked to have seen it probe this level and close near 51 to get long. It closed weak on the day, and it's just a matter of coming back in after that. Let's see, Starbucks back in late January, earnings again. Not too significant of a gap, about $2 here. But just enough. No surprise, no beat. It looks like I reported in line. Year-to-year revs are 10%. So I wouldn't really be taking too much of a day trade there on that, just because it's just not a significant gap. First pullback going on right there. Comes back in another day, and kind of establishes this little range right here, and then breaks down. You're gone out of the position. I would not be holding it after that. It's just kind of this, and this is where you just kind of want to just focus on this range. After you get that first pullback, especially if it takes out the prior earnings gap, then you're looking for this next, for some sort of closure of the gap of some sort, and you want to see price go in. You always want to see price go in the move of the gap. If it's not going in the move of the gap, it just, the whole pattern starts to fade away, and you start questioning yourself, and you can see that the action just gets really choppy usually. Once this broke down below 55, I would have been gone out of this. Anyway, let's see another example. I just want to focus mostly on their earnings. Usually these setups and these first pullbacks and trading opportunities are going to come about within a week or two. If you start waiting 3-4 weeks in a position based upon earnings, to me, I don't have the patience for anything like that. I want to go into a stock about, like I said earlier, 5 days, maybe 3 to 7 days after earnings, and try to look for an opportunity there for some sort of continuation of the gap trend to continue. JCOM, you can see gapped up on earnings. A lot of shorts are covering on this one. This wasn't what I call a gap and go day, even though it was a higher high, just because it closed lower. So in that case, this becomes more of a first pullback. I have to focus on the opening of the day's range. The reason I focus on the opening here is because it was in the middle of such a wide range day. So that's going to act as a support level. You see it kind of held 2 or 3 days later. And you kind of give yourself some wiggle room with these things. There's stop orders that are always placed around these levels. You're going to see price action flush through and then try to make some sort of recovery. And it's the recoveries in the direction of the gap that you're going to want to really kind of jump on board. But the key thing here too is also to know your risk level. So if you did take a long somewhere here around 35, 35 and a half, you knew that you're still in pretty good shape above this low here, which is 34. And you can see that the price did eventually start rallying with the rest of the market here in March. SIG. This is another jeweler. This is a jewelry stock that is on our BlueX list, and I believe it showed up on our Liquid Momentum once or twice as well. And here's an earnings report in late March. It seemed to be okay, decent enough. Gapped up about $3 or so, but you can see that it kind of sold off a little bit, kind of popped higher. So I'm going to put my support and resistance lines, pretty much around the opening of the day and the low of the day going forward. You have a little first pullback. It's not really a pullback considering it was an inside day, but this would be more of my significant pullback level. Price comes sinking down, touches the earnings gap, and finds a buyer right above the 65 level. That's good enough for me to take a small position going forward. Gap lower the next day, which kind of stinks. There's probably some sort of overt global headline or economic data that came out that day that caused that to drop. But you can see that buyers just stepped right in strong. For me, this is just jump on board. Put your stop down here below 65 area and try to get in somewhere at a reasonable price below 67. Next day, momentum goes higher, and hopefully you're looking to take some profits when the stock moves about $2 or $3 in your favor. Again, price comes sinking back in, and that brings us right to here. It's kind of holding this level right here. Let's see what else we got. So Under Armour, another earnings gap. Gapped up, pulled back the next day, mark off the previous day's lows. Could take a buying opportunity somewhere around $50. Went up to 51, but kind of struggled to get above that first pullback day. Came back in, just really kind of chopping around here, not acting as well as it should. Again, this is where it comes where you kind of have to make a judgment call and say, all right, how well is the stock behaving after earnings? It's chopping around, it's holding the gap. You know, is it going higher? Should I get out of it? And like I said, anywhere once you start getting out beyond a week, especially for a swing trade, and it's not doing anything in your favor, I'm losing patience in it. I'm probably gonna look to start hedging it or just kind of reducing my size. Just want to do. I just don't. I want to make money. You know, I don't want. I'm not looking to make quick, get rich quick. But I want. You know, when I'm in a position, I want it to be working in my favor as pretty much as quick as possible. And a stock like this, I would just be losing patience with, and eventually just take a loss with. You could just see how this support, which initially held here, was just starting to become more of a resistance phase here too as well. So again, a key thing to focus on is this opening of the gap earnings and the low or the high of the range, and how stock price reacts to that in weeks to come. Let's see, RAX. RAX is a huge one. Big gap down on earnings. Looks like I forgot to mark this one. So gap down earnings. Next day looks like it was some sort of pullback reaction. So I kind of just want to mark that off right there, like that. This would be my key resistance area going forward. If price ever got back to here, I would really be looking to take some sort of short if it failed up here. So in a pullback, you then want to see if there's some sort of continuation move to the in the direction of the gap. And sure enough, the second day it started breaking down. Anybody who has tried to bottom pick this stock, you know, right here underneath $60, they're underwater right now. They're going to be looking to dump their, cut their losses. You know, and you got to look at the overall context too. This is actually a really strong stock. So to go back to what I was saying earlier, if you're looking for day trades and gaps, all these people, almost 2.5 months worth of investors, are now trapped in losing positions. So when the stock gap from 74 down to 65, I mean that's about what is it, 8 points, 9 points of losses. No one's adding to their position. It's just not going to happen. I'm sure their earnings had to be poor. They guided significantly lower. They're looking to cut their losses. Something like that, if you're day trading, this is what you want to be focused on. Poor earnings, poor reaction earnings, huge gaps to the downside. You know, you want to really kind of look to take some sort of short on opening range breakdown or the first pullback of the day. People are not going to be adding to these positions here. The only thing that might turn it around would be what I said earlier, would be a conference call. If a conference call comes out maybe an hour or two later, and the stock's significantly lower, and then management somehow, you know, reaffirms something, and investors get all excited again, and they start, you know, racing the stock back higher. Otherwise, just go with the flow, go with the gap. You know, these are short-term day trade, swing trade type of setups that I'm focusing on here. And again, the whole title of the webinar that was my favorite type of patterns, and this is what I'm looking for when earnings season comes around. So that's RAX, Riverbed. Here's another one. Corner of my eye here, I see Q&A says, what charting service do I use? This is eSignal. You don't really need, you know, any charting service will do. Not plugging anybody, but you can pretty much, it's pretty easily identifiable just on the gaps themselves. Any charting service should help you. So let's see. So big gap down here on earnings in late February, early February, excuse me. And the first thing I want to do is mark off the high, mark off the low, and mark off where the price opened that day. Next question, who's trapped? Well, you got about a couple weeks worth of, you know, longs, maybe two or 3 months worth of longs trapped in this position. They're going to definitely be looking to cut their losses on such a significant size gap. So this is something that I want to be focused on the short side. The next day price pulls back. You know, it's an inside range bar. I want to be looking to short if there's any sort of test around 17 and a quarter. I might take a short if it breaks below 16. If there's any signs of to trap some bottom pickers from the last 2 days. Price sinks a little lower. Probably gets short. This isn't too comforting because we didn't get a significant breakdown. Price gap's a little higher against you, and you know you're questioning whether your short was the right call or not. And if you stuck it out, price started slumping a little bit lower. And then you can see here, this is, I'm going to get into this in a little bit too, is that this range low, and again, this is why I mark these off and try to extend them out. Nobody was probably watching this stock after almost 3 or 4 weeks after earnings. And sure enough, price was rallying slowly back up into it and tagged it at 16, failed. That's a shorting opportunity. Next day, price just continues lower and sinks down for a gain. So again, this is, if you get anything out of this webinar, and you have a charting service that you can draw on, or if you even don't have a charting service, just note the high, the low of the earnings day, especially on a particular, especially on a big gap, and as well as the opening. And when price gets back to those levels, even if it's 3 weeks, 4 weeks after the fact, they can act as significant trading opportunities as support and resistance. Let's see, it's got a few more. This is Williams-Sonoma, big earnings gap. Pulled back again. Who's trapped here? We have a significant amount of buyers are definitely in favor here. Anybody that's been short the stock the last few months has to cover. So you can take this for a big gap, 2 points, maybe for a day trade. First pullback range. The wider the range of that earnings day, I'm going to be more focused on the first pullback. That's where I want to kind of be focused on. I don't want to be focused all the way down here at the bottom of some really wide range bar. Price probably won't get back there on these really strong closes, strong finishes. But the first pullback now becomes your more solid support zone to work off of. Like I said, these bigger moves, they reset the charts. You almost have to start from scratch. So going forward, this is going to become your new support zone that you want to focus on. Price rallies up a few days, came back in, and I can't make this stuff up. It held the high of the first pullback day as support, right along $50, and rallied higher. Titan. I want to focus on this one. It's because I remember there was a subscriber just last week came in. These are really, really difficult. When the gap's down significantly, this looks like a gap down about 18%. You gotta ask yourself, should you be, for me, I'm not buying the stock. I don't care how far down it is. I see too many trap positions here. It's a pretty small name to start off with, trading 200, 300,000 shares a day. So it just seems like it's got to be more manipulated by bigger players who have to either, buy the stock or get out of the stock. I'm probably going to avoid it for some sort of day trade of sorts. But what's significant here is what happened the day after. Again, I just kind of put my ranges right there, and you can see that the price, even though it was a gap down reversal, the next day there was no buyers. If they broke it above this high here over the next day or two, I probably would have tried to take a long and see if I could squeeze more people out of it, just because they have this gap. Maybe prices were rallying. This case, it really wasn't it. It came down to the low. You could probably take a short right here, or a short even on this reversal day, this failure. And this is a stock that I'm just going to be looking to, I don't really trade stocks this thin, but if I was, I'd be looking to short it at any time, if it came back to this high here. F5. I didn't do this one yet. All right, so F5 gap down just recently on earnings. And you can see it kind of pulled back. It wasn't really a follow-through day the next day. And you want to look to short. Again, you got to make those ranges on those earnings days. Mark the high, mark the low. You can mark the opening if you want. And these are going to be your new support and resistance areas because the chart resets on such big moves. You have a lot of trapped positions of investors as stocks gap down to multi-month lows, multi-week lows. And, taking a short against a resistance area on the first test is usually a pretty good trade to take, especially if you wait for confirmation. You can see some failure. Another earnings gap back here in late January. Price gapped up. You can see I marked the high and the low. The opening was around there. And what this looked like was kind of an inside day the next day. And you're looking for either a breakout above this high here, or you're looking for some sort of retest around 102 to buy. And it looks like you got the retest, probed 102. Price closed around 104.80. I mean, hopefully you got long somewhere as price was rallying, and you were able to get maybe a few dollars out of it within the next 2 or 3 days for a swing trade. Looks like I have another earnings gap over here labeled for F5. Again, first thing I see here when I see a gap down like this is there's a lot of long positions that are trapped, and I'm going to want to be focused on the short side. Again, the first day I marked off the high and the low of the day, and I'm going to be looking to see what develops from there. Gap down, you have a pullback the next day. I'm going to probably look to go short. Did not take out the prior day, did not take out the gap day low, and actually popped higher there. Stalled. That's a good signal. I would probably take that short right there at 85 and get squeezed. And I labeled it a false rollover, which actually is bullish. So you can see that, as I said, I was going to, I probably would not have been buying the stock here. I probably would have been more inclined to take the short here on signs of a failure of gap resistance. And then the next day you can see you're questioning your short, whether it's going to work out or not. And you know that if it gets above here, the buyers are going to be in control. And that was the case. Took out that high, and they just started to lift it. Like I said, this isn't an exact science, but these are patterns that I do like to look for. They do work out a good chunk of the time. I covered Oracle already, I believe, or I covered it on the one side. The second pattern was the gap and go pattern. And I'm starting to run a little longer than I wanted to. Basically, the gap and go pattern is a multi-day run. So here you can see prices close lower for 2 consecutive days. Third day, and then I'm looking for the first pullback day. This first pullback day is usually going to be, where I want to mark off my support and resistance going forward. In this case, there was no continuation move in the direction of the gap and go to the downside, but instead price rallied and it stalled again at the gap resistance level. Once it stalled here, you could have taken the short anywhere in the $32 area and caught it for a small little move back down. Once here you can see price came back up again. The more gap resistance area or support zone is tested in a short time frame, it's typically going to just break through it. So that's something to be aware of. You usually want to pay attention to the first time that these things are retested and fail, or first time and confirm. That's always going to be the best trading opportunity. It's very rare to see levels hold the support and hold resistance more than 3 or 4 times. All right, so Fedex was another one. Fedex, big gap down on earnings. Second day, gap down again. This becomes a gap and go pattern. So what I'm looking for is the first pullback to become my new support and resistance. So on the third day, it pulls back. This is my new support and resistance area. There's confirmation right here. It takes out the low at 97. I would look to get short. And you're sitting there and you're questioning yourself, what is this short going to work out? It's 98. Kind of pops above there. Again, it's still within the first pullback range and failed. If you're swing trading, it's this is a lot easier to do. But usually, like I said, this is kind of the reverse of what I showed earlier of the first pullbacks. You can look at this as more of the confirmation that this range is now holding, that price is not going to get up to the 102 level, and that this first pullback is going to be the new established resistance going forward, which, again, you could probably take as a short, and that kind of worked in your favor for a few points lower. Let's see if I can get a better example. Nike. I know somebody asked in Q&A about this Nike. So big gap back in late December. This is a breakout, I think, to new all-time high. No, it wasn't new highs. But it was a significant breakout. Anytime you see a real easy technical breakout, earnings, they surprised by 14, and revenues were up 7%. I mean, that's pretty good. You got to get some sort of, easy breakout just to jump on board and buy that. You can see this was a gap and go type of trade because it did close higher on the second day. So let's zoom in on this. So it closed higher the second day, so it becomes what I call a gap and go pattern. And I'm going to want to really focus on the first pullback becoming a support level in future days. First pullback comes down to the opening, and it starts to show signs on the third day that it's holding. And fourth day shows that it's not holding. Fifth day holds the gap low right there. I mean, these are all, it's pretty small. I mean, this is all within 50, almost within $1 range right here. For a swing trade, it's usually you should be giving yourself minimum, usually what the ATR is on the stock. At this point in time, I would assume it's a little bit over $1 for Nike. So you should be risking maybe $1, $2 just to sit with the stock, see if it works. And you can see that here's the first pullback. So you want to really kind of break over that first pullback high. And a few days it just kind of sat there and held, didn't really do much. This is a type of setup that you really kind of want to just stick with and focus on. There's no real selling pressure going on. You know where your risk levels are, right below the $51 gap support. So this is a trade that you can kind of just stick it out for. And a little bit later, so this is ones you just want to kind of really nice see drift higher. With the gap and go patterns, you can see that more likely. As opposed to the earnings gaps. The ones where stocks gap in a significant move and there's a pullback immediately the next day, they tend to chop around a lot. And, the gap and go ones, that means that institutional money is there a second day. One day was not enough for them to get into a stock or get out of a stock. They had to go for a second day or a third day because, evidenced by their higher or lower closes. So you always want to be willing to give those trades a little bit more room in the direction of the gap. Here's our earnings gap. First day, again, huge gap right here. Earnings were a little bit of a beat, but all these short positions are trapped on a significant gap up of about $4 or $5. So for a day trader, you want to look for a squeeze and try to ride it higher. For a swing trader, you want to kind of wait till price action settles down. There's your first pullback day right there. So you're looking for a breakout above 60 to get long, or you're waiting for some sort of pullback to the gap and confirmation of it holding to get in there. You can see Nike just kind of chopped around for about a week and then started to move higher and push higher, and here we are back into the first pullback day support area. Let's see, I only have two or three more I just want to go through. So again, Netflix was a big one back in January, gapped up, huge gap up, I should say. Tons of short positions. We know at the time that there was a big debate in the media about everyone who was short and who was, bullish and bearish in this stock. And just this huge earnings gap, 40 points almost. I mean, short squeeze galore. You just really wanted to be on the long side on this one. You can see that there was a gap and go because of huge follow through the next day. So I want to be focused on the first pullback day. First pullback day, I'd kind of define right around, this was a higher high, but I would say the first pullback day would be right here in this range. And I'd kind of just want to mark it off on the chart. I didn't really care about this low down here because if price started reversing a 30-point gain, I wasn't really too sure if I wanted to be participating in that. I figured it would go lower. So I kind of just more focused on the first pullback that developed here. You can see there was buyers the next day. Stock sold off, chopped around. But it started establishing a new support around 160 area. You were looking for a breakout above 175 vicinity, and it came a few days later for about, it looks like almost a 10-point gain, 15-point gain. And then on these gap and go days, the first pullback, again, you want to look to see what happens maybe 2 or 3 weeks after the fact, because they do tend to become a new support area. It's usually the first pullback that becomes a new support. It's not necessarily the initial gap day itself, especially on stronger stocks. You can see that you could have taken a long here on this very low volume, narrow range day, and took another swing higher there. And actually this new support zone based upon the first pullback high became a new support zone over the next coming weeks until just here in April. And now it looks like recently that this is actually becoming a resistance area, all based upon that first pullback high. Again, this is just something that you're not going to see in too many textbooks. It's just something that I've just I've just seen over the years over and over and over again. Let's see, last one. Let's see if we do LinkedIn. Then I'll go to questions. LinkedIn, another big one, February earnings gap. Year-over-year revenues are up 81%, beat by 16 cents. Shorts are going to get squeezed. Stock gaps up almost 20 points, 15 points. Day traders, you want to be focused on the long side. And gap and go set up because there was follow through the next day. I marked off my first pullback. So this is going to become my new support zone that I want to be focused on around the 155 area, not the 140 area. You can see that it only held for a day, price broke out again, started rallying higher. I would even probably use this as a next pullback, considering it was such a quick. I probably would have marked this off as well as my next second pullback support zone. Just going forward, just one of those things that that would be my next like breakout point and bullish move I'd be focused on. But initially, I want to be focused on being a buyer somewhere down here in this 155 area. And almost 2-3 days later, after the fact, you can see it kind of dipped in there. You had a doji close. This becomes my new support area. Some confirmation there. Hopefully, I'm on the long side by this time. Pulls back. You know, things aren't looking so hot, but I know the support level's here. And look at that. Sure enough, price follows through the next day with the support area holding. First pullback after a gap and go setup. And you can see the stock price went significantly higher. That's pretty much the two patterns, I should say, you know, that I focus on. So in summary, let me get that PowerPoint back up. Let's see. So in summary, you know, you want to watch the fundamentals. Obviously, if it's strong fundamentals and there's earnings beats and there's increase in year over year and they guide higher and price is gapping higher where it's going to trap short positions, or, you know, you want to focus on the long side. You know, and vice versa. If everything's negative fundamentally and the price gaps down significantly, you want to be focused on the short side. The small gaps, you know, if I try not to trade them too much. They're good for scalps. You got to be really quick on those. You got to watch for the opening reversals. You know, if it's just not significant of a move into earnings, there's no shift in the mentality of people who are long and short already. They probably going to look to add to their positions. You know, when you get the larger gaps, that's when they're going to sit there and say, we're wrong. It now becomes a case of risk management. We have to cut our losses. We need to cover our shorts. We need to get out of our longs. And that's where you're going to see these type of larger earning type of gaps. And you're going to look for more of the gap, the first pullbacks to take effect. And you're going to look for the gap and go type of movements to take effect. And that's really kind of the way I approach earnings season. Those are like the two best patterns that I could find. So thanks for coming today. For those of you who have to go, I'm just going to run through some of these Q&A questions and see which ones I can go after. Yes, this video is going to be recorded. It will be up on the Briefing YouTube channel. There's also going to be a link sent out to those who registered for the webinar. It's also probably going to be embedded somewhere into my swing trader column or somewhere in play in coming days. The definition of average true range, you're not going to find it on the briefing site. It's kind of a technical term. It's actually really math specific, but generally speaking, they take the average true range over the last, the default is 14 periods, and you know, they just kind of take the highs and the lows of those 14 periods, and they come up with a number. That's the easy math formula for it. Generally speaking, you can pretty much eyeball. Just look at where the stock's been trading. Just take the high and the low, or just take an average range. Say, hey, it trades $2, $3, $4, $5 a day. When earnings comes around, I want to see it move or gap more than $2, $3, $4, $5 a day. If it doesn't gap more than that, then it's going to be more subject to a fade or a chop or an adding of positions of sorts. Today on Intel, reported earnings. Can I use that as an example? Sure. Let's look at Intel real quick. I believe it's trading higher, I want to say. I was getting ready for the webinar. All right, so Intel after hours spiked, and it seems like it's much lower right now, 2180. All right, so it's really right around the close. If it's going to open around 2180 tomorrow or 2190, 22, I mean, you can look. I don't even have to look at the average ATR. I know it's, you know, probably in the vicinity of about 40 to 50 cents, just based upon the recent price range between 22 and 21. You know, if it's going to open anywhere in this vicinity, I'm probably not going to trade it. Probably look for some sort of opening reversal. If they open it lower, you know, look to buy it. If they open it higher, look to short it. You know, anywhere in this range. It's just going to be too choppy. It's really not my style. If they were to gap this up above prior resistance levels, you know, a significant, say it was gapping up like $1, and it was going up, opening up over 22.50, 23 tomorrow. well, then I'd be focused on the long side, assuming that the fundamentals are also in its favor. And then I'd be waiting for a pullback day, and I'd be waiting for the buying the support level over the next coming days. Same thing on the downside. If it gapped down here somewhere, I'd be more inclined to think that all these people are going to be trapped on the long side, and the pressure was just going to be on the downside. More Q&As. Someone asked, do I think that all the algorithms and the computers and stuff have messed around with the patterns that develop on the chart, which are usually the result of psychology? That's a good question. I think they've messed around with more of the shorter term patterns. Considering the high frequency trading, all the algorithms seem to be focused so much more in the short term that you're going to see a lot of the short term patterns really not work out and fail more often than usual. But bigger picture, I mean, if you always just focus on this, I mean, I don't think the algorithms have much of a say, when it comes to mutual funds and insurance companies and pension funds and these massive players and the millions of share size that they take in their portfolios. They are not getting out because the stock, did a little false breakout on a 50-cent support level or something like that, whereas high-frequency traders might be all over that. They're going to pretty much sit with the stock, look at the dividends, look at the fundamentals, and wait for earnings season to be some sort of key factor to shift their thinking and their positions. Again, this is really why I like to focus more on the larger gaps. So when you see a larger gap, you know that the bigger institutions are involved. You know the big money's involved. You know they have to manage their own risk. And usually their first strategy is going to be not to add to a losing position. It's going to be to mitigate and cut their losses, which is why a lot of these trades are going to work. You're going to see these gap and go type of trades work for 2 days, or you're going to see a pause or a first pullback when no one else is focused on that first pullback, or the shorts or longs. They think that they caught the reversal. The third day after the earnings, fourth day after earnings, fifth day after earnings. That's when these institutions are going to try to sneak in there, and they're going to start pressuring the stock again in the direction of the gap. Goldman Sachs today, earnings were nice, fundamentals were nice, it gapped down, and it faded late. Do I have any thoughts on it? I used this as an example earlier. This is a $3 stock, and it opened within yesterday's range. There's nothing for me to do there. To me, this tells me that the institutions that own all this, based upon today's opening, I couldn't tell if anybody was trapped long or trapped short based upon the prior week's range. Institutions probably were not panicking out of anything. They weren't jumping in as a long. They weren't jumping in as a sell. The only people that really had to be concerned were the people that bought it the day before. Just really wasn't my cup of tea to jump aboard and start trading this. And as for the reaction into the close, it went against the market, which is a negative overall. But I don't really see much of an opportunity here going forward to trade it. For me, this becomes a stock where earnings is a non-factor now, and now you just got to go and focus on your basic trend lines. Multi-week trend line down, key resistance right here at the 150 level, based upon this breakdown and the failure and the retest. And now you have to start looking at, maybe I took all the averages off the chart, but you have to start looking at 200-day moving averages and different gap levels if you're interested in buying the stock, or you have to wait for a breakout higher. Again, if it's a small reaction, it's a small reaction. I try not to get too involved in that because you're not really sure where it's going to go over coming days. I like the bigger reactions because I know where there's support and I know where there's resistance and I know where my risk is. Do I use the extended trading day to calculate my daily range? It's 9:30 to 4. I don't use extended intraday ranges. Again, this is not an exact science. This is just something that I've noticed over the years, and there's no set percentage. There's no set price. It's just look at the price action, see where it is in relationship to where it's traded prior, who's on the wrong side of the market when this thing gaps. Is it breaking below support? Is it breaking below support and shorts and longs are in losing positions and have to get out, or is it breaking above resistance and shorts have to cover and get out? And then the gap itself. I try not to get any more complicated than that. Intraday pullbacks on earnings are totally fine. You can see that there was definitely one in Goldman today. Let me get off this extended hours daily. So here Goldman, again, opened up higher, sold off hard. First hour came around, started to bounce a little bit. This is an opening bullish. This is a bearish flag pattern right here, below the prior day's low of 145.50. Could probably start to look to get short in this vicinity around 145, and then price kind of just rolled over into the afternoon. Didn't really confirm to the downside, but yeah, you can always look at intraday pullbacks. It's a little harder sometimes on stocks like I think Coca-Cola had earnings. That's not Coke, that's Kellogg. Coke. So Coke, this is key too. Stock sold off really hard yesterday, and you can see it just gapped above the previous day's range. I think this is a multi-year high for the stock too. There's a short squeeze going on here, just based upon the shorts, people that have been trying to short Coca-Cola, the last few weeks here, thinking it's too extended. Gapped up, and on a 5-minute chart, you can see it kind of just took off right there. It's once it was up $2, it's not really a stock that I want to be focused on for any sort of buying a pullback, or what was it to go up $3? Probably not. For me, this is going to be a stock that I might focus on, over the course of the next week, when earnings season really picks up. No one's going to be wanting to really focus on this stock about 3 or 4 days from now, and yet it could easily creep higher above this range here on a first pullback, or it can come back here and offer a nice swing trade entry at 41.50. UNXL, I'm not sure if they had earnings. It was a big move today, I think, right? I'll have to go check and see if they had earnings. But this is just your typical resistance breakout pattern right here. Why it did it today, I'm not sure. I have to go and check on earnings. I don't know that one. I should have looked at that. You can email me, and I'll give you my analysis on UNXL. I find the gap up's much more reliable to trade than the gaps down. Depends what type of market you're in. If you said that back in 2007 and 2008, it would have been total opposite. Recently, we're in a massive bull market, especially the last few months. So the gap ups are going to be much more reliable. So you got to look at the bigger picture when it comes to things like that. Would I have played Yahoo on the gap up and reversal today? I don't understand what that means. It didn't have earnings today. It has earnings. It had earnings after the close, I believe. So yeah, so it's trading at 22.84. So it's trading about down $1. I probably won't touch it tomorrow if it opens up down $1, just because it's been trading, pretty strong. It didn't really take out these lows here. If it opens, it's going to open somewhere right along. It looks like the high here, 23, 22 area here. I don't know. I don't see people rushing. I don't see institutions, making a mad dash for the exits in the stock, given the strong performance it's had. I didn't see the exact earnings numbers and how they guided or whatever, but I don't see any sort of panic for institutions to be getting out of this stock, unless the fundamentals were horrible. I have to look at that. SLW or GLD, they're not really earnings related, but I guess you can always apply, anytime there's a significant gap, news related or just headline related of sorts, you can always apply this methodology. This is a gap and go type of day. So we broke down significant gap the next day. I mean, if we gap down another day here, I'd probably be looking to buy under 130 if it was a gap. But otherwise, it's tough because this is not earnings related, so this is going to be a little bit difficult to play. But you can always apply the same range methodology. I would say this is a first pullback, right here inside of the gap day. And I'd be focusing on these as resistance areas, and these as potential breakdown areas for people who've been bottom picking. All right, so UNXL had a press release, it looks like. That's pretty much it. So hopefully, I'll just pull up one. I have one more example here. I think this was Constellation Brands. Again, the reason I saw this one was this was on one of our GrowX lists and Liquid Momentum lists for the latter half of December 2012. For just 2012, I'm sorry. Got crushed here. I can't even say if it's earnings or not, but this gap just jumped out at me when I was scrolling through my charts. And I would almost guarantee that this was some sort of earnings. So again, just to show you a naked chart that I'm drawing the lines on, just always highlight your charts, highlight the opening of a big gap, the low, and the range going forward. First pullback, I would note that, highs and lows, because this is going to become, if it's such a wide, if it's a wide range day, this is almost 4 points here on this gap up. Your first pullback is going to be more significant as a support going forward. Price pulled back a little bit, came back in, tried to break out, and then just kind of stabilized here in this first pullback support zone. I mean, when you see that, there's very, very few people who are getting excited and really day trading or talking about this stock and any sort of bull flag pattern or whatever they're talking about. They've already moved on 3 weeks later, 2 weeks later. But this is really when you want to kind of just sneak in there for a low risk entry point, knowing that your risk is way down here, and then you can just get long, and then hopefully it works out in your favor. If it started breaking down below the support levels, well, then that's a whole different story. You got to bail. So that's the end of the webinar. I want to thank everyone for showing up today. I know I went long again, but hopefully you got a lot out of it. And if you have any questions, send it to swingtraderbriefing.com. This is recorded, and you can go to the YouTube channel. Just search for briefing.com, and hopefully you'll be able to, hopefully you got something out of this. I appreciate it. Thanks for coming.